Welcome to the Deep Dive, the show that really tries to cut through the noise and get straight to what's essential, surprising, and frankly, useful. Today, we're tackling something that touches nearly every one of us, sometimes without us even realizing it: capital gains and losses.
Hmm.
And this isn't just for, high finance types. It's for your investments, maybe your home sale, even digital assets these days. Our mission here is to take what often feels like complicated tax stuff and make it clear, make it actionable knowledge. We're hoping to uncover some surprising shortcuts that could save you a ton of time, maybe some strategic insights too.
Yeah, and what's really interesting, I find, is just how often people do interact with capital assets, maybe even daily, without fully grasping the reporting side, or maybe more importantly, the strategic side. Understanding these concepts, it isn't just about, ticking boxes for the IRS. It's really about seizing opportunities, avoiding some common mistakes, and ultimately, well, turning these complex rules into a bit of a financial advantage for yourself. Think of these insights as your roadmap, helping you navigate investments with hopefully a lot more confidence.
Absolutely. A roadmap. I like that. So let's dive straight in. We've all heard the term capital asset, right?
Yeah.
But what does that really mean for us, in practical terms? And what counts as disposing of one, especially now with things like crypto and NFTs?
Good questions. Basically, a capital asset is, generally speaking, any property you own and hold, either for personal use or for investment. So yeah, stocks, bonds, your house, maybe even that classic car you're fixing up. And for 2024, yes, definitely includes digital assets, cryptocurrency, NFTs, if you held them as an investment or, for personal use. Now, disposing of an asset, it's not just selling it for cash. It could be trading it, exchanging it, gifting it, basically any transfer where you give up ownership. To report these, you'll generally use two main forms. There's Form 8949, that's where you list out the details of each individual sale or exchange. And then there's Schedule D, which is part of your main Form 1040 tax return. That's where you summarize everything from the 8949s.
Okay, so 8949 is like the detailed list, the ledger.
Exactly, the transaction ledger.
And Schedule D is the summary sheet that pulls it all together for the tax return.
You got it. It's the toolkit for turning your investment moves into tax figures.
Right, makes sense. A ledger and a summary. But here's where I think it gets really interesting for a lot of people. Not everyone actually needs to fill out all these forms, right? You mentioned shortcuts. What are these exceptions, the ones that could save us maybe a load of paperwork?
You're right. There are definitely situations where you can bypass some of this. Let's look at two key exceptions. The first one is, well, it's a big one. You might not have to file either Form 8949 or Schedule D at all.
Okay.
This can apply if, number one, you had absolutely no capital losses during the year, and number two, your only capital gains were from capital gain distributions. Specifically, the amount shown in Box 2A of your Form 1099 DIVs.
The distributions from mutual funds and things like that.
Exactly. But, and this is a crucial but, if
Okay.
any of your 1099 DIVs show an amount in Box 2B that's unrecaptured Section 1250 gain, usually from real estate depreciation,
Okay.
or Box 2C, which is Section 1202 gain from small business stock, or Box 2 gain collectibles gain, if any of those boxes have numbers, you don't qualify for this specific exception.
Got it. So it has to be only Box 2A gains and no losses at all.
Precisely. If you meet those conditions, you just report that Box 2A total directly on Form 1040, line 7, and check a little box there. It's definitely a nice time saver if your situation is that straightforward.
Yeah, that does sound simpler. Okay, so that's exception one. What about the second one?
Right. The second exception is a bit different. Here, you do have to file Schedule D, but you generally don't need to file the detailed Form 8949.
Okay, so Schedule D summary, but skip the 894D9 ledger. When does that happen?
This usually comes up if you didn't qualify for that first exception, but your gains and losses fall into certain categories. Like if you have a capital loss carryover from a previous year, or if you have gains from specific situations reported on other forms, like installment sales on Form 6252, or maybe casualty losses on Form 4684. But probably the most common reason is this. You received a Form 1099-B from your broker.
Right, the one we were just talking about.
Exactly. And that 1099-B shows that your cost basis was reported to the IRS. The ordinary income box isn't checked. And, this is key, you don't need to make any adjustments to the basis or the proceeds shown. No adjustments for things like commissions not already included or wash sale losses disallowed.
So if the broker's form is complete, accurate, reported to the IRS, and needs no tweaking,
then you can often just report the summary totals directly on Schedule D without filling out Form 8949 for those specific transactions. Many investors fall into this category. Knowing these exact conditions, it really can streamline the whole tax prep process quite a bit.
That's incredibly helpful. Seriously, it sounds
Yeah.
like really understanding those forms you receive is step one. So once we figure out if an exception applies, and for many of us, maybe it won't, the next step is digging into those information forms. You mentioned the 1099-B. Let's focus there first, since it's so common. How does that guide the reporting?
Yeah, the Form 1099-B proceeds from broker and barter exchange transactions. Your broker sends this out for sales of stocks, bonds, sometimes commodities. It's really your primary guide for filling out Form 8949 and then Schedule D. Typically, you'll take the sales proceeds figure, that's usually Box 1D, and put it in Column D on Form 8949. And the cost basis, usually Box 1A, goes into Column E on Form 8949. But, and this is a really crucial point, something people often miss, what if you paid selling expenses, like a commission, and it wasn't already subtracted from the proceeds in Box 1D or added to the basis in 1E?
Right, like that brokerage fee. So those extra costs can actually lower your taxable gain.
Yeah.
How do we make sure we account for that?
Exactly. They absolutely can and should reduce your gain or increase your loss. Let's use a quick example, similar to one in the IRS materials. Say you sold 200 shares of some fund KLM for $10,000, and you paid a $100 commission on that sale. Now, if your 1099-B shows the gross proceeds of $10,000 in Box 1D, that $100 commission hasn't been factored in yet. So on your Form 8949, you first put an E in Column F. That code tells the IRS you're making an adjustment.
E for expense or E for exception?
Well, the instructions just say use E for expenses not reflected in proceeds or basis. So you enter E in F, then your $10,000 proceeds in Column D, your basis in E, and then here's the key. You put that $100 commission as a negative number in Column G, the adjustment column.
Negative $100 in column G.
Right. That ensures the $100 commission effectively reduces your gain or increases your loss calculation. It's a small step, but it directly impacts your tax bill. It's making sure you only pay tax on your actual profit.
That's a fantastic, really practical tip. Okay, so that's stocks and bonds via 1099-B. What about real estate? Selling a house or land, is there a different form for that?
Yes, there is. For real estate transactions, you'll typically get a Form 1099-S, proceeds from real estate transactions. This usually comes from the person responsible for closing the transaction, often called the real estate reporting person. Could be the attorney, the title company, maybe the mortgage lender or broker involved.
And what kind of real estate does it cover? Just houses?
No, it's broader than that. Reportable real estate includes improved or unimproved land, any permanent structures like houses or buildings, condominiums, even stock in a cooperative housing corporation. Standing timber sometimes too. Box 2 on that Form 1099-S shows the gross proceeds from the sale.
Gross proceeds?
Yeah.
Okay. Any quirks with the 1099-S we should know?
Well, one interesting point is that the reporting person, the title company or attorney, is actually prohibited by law from charging you a separate fee just for filing this form. It's part of their closing responsibilities.
Good to know.
Also, just a side note, if you're doing a like-kind exchange, swapping one investment property for another, that gets reported on a different form, Form 882-4, not the 1099-S.
Okay, and what if
Hmm.
What if you get one of these forms, like a 1099-B or S, with your name on it, showing proceeds, but the money isn't actually yours? Maybe you were just holding it for someone else temporarily.
Ah, yes, that's called being a nominee. If you receive income or proceeds in your name that actually belong to someone else, you're acting as a nominee. In that situation, you have a responsibility yourself. You need to file your own Form 1099-B or 1099-S, whichever matches the original form you received, with the IRS, showing the actual owner as the recipient.
So you basically pass the reporting obligation along.
Exactly. You're redirecting the income to the correct taxpayer in the eyes of the IRS. And there are deadlines. For 2024 proceeds received as a nominee, you generally have to file that 1099 with the IRS by February 28, 2025, or March 31st, 2025 if you file electronically. And importantly, you must also provide a copy of that form to the actual owner by February 17th, 2025. It's about making sure the income trail leads to the right person.
Wow, okay. This all really underlines the need for careful record keeping, doesn't it?
Absolutely.
But once we have all this data sorted, the next big piece is understanding the timing, how long you held the asset. What does it all mean when we talk about short-term versus long-term capital gains and losses? Why does it matter so much?
This distinction is, well, it's fundamental. It can literally mean hundreds or even thousands of dollars difference in your tax bill. The key dividing line is exactly 1 year. Any capital gain or loss on property you held for 1 year or less is classified as short-term.
1 year or less. Short term. Got it.
These short-term transactions get reported in Part 1 of that Form 8949 we talked about, and then the totals are summarized on Schedule D, specifically on line 7. Now, if you held the property for more than 1 year,
Longer than a year.
right, then any gain or loss is considered long-term. Those go into Part 2 of Form 8949, and the totals are summarized later on Schedule D, down on line 15. Finally, on Schedule D, line 16, you combine your net short-term result from line 7 with your net long-term result from line 15 to get your overall total net gain or loss for the year.
Okay, so parts 1 and 2 on 8949 for short and long, summarized on line 7 and 15 of Schedule D, combined on line 16.
Precisely. And why this matters so much comes down to tax rates. Net long-term capital gains typically qualify for much lower tax rates than short-term gains. Short-term gains are just taxed at your regular ordinary income tax rate, whatever that might be.
So holding for longer than a year can mean paying significantly less tax on the profit.
Exactly. You can think of it as sort of a tax incentive for patient long-term investing.
That 1 year mark really is a crucial date to track then. Okay, now let's pivot slightly to the less happy scenario. Losses. Nobody likes investment losses, but knowing how to handle them is really important. How do the rules work for deducting capital losses? And what's this carryover thing?
Right, even when you have losses, there's a way to get some tax benefit from them. If your total capital losses for the year exceed your total capital gains, you can deduct some of that excess loss against your other income, like your salary.
Okay, deduction, how much?
The maximum deduction allowed against ordinary income in any single year is $3,000. Or if you're married filing separately, it's $1,500.
$3,000 per year max deduction.
Correct. You report this deduction on Form 1040, line 7, usually shown in parentheses to indicate a negative number or loss. Now, what if your net loss is bigger than $3,000? Let's say you have a $10,000 net capital loss for the year.
You can only deduct $3,000 this year. What happens to the other $7,000? Does it just disappear?
No, and that's the good news. It doesn't disappear. The amount of your net loss that's more than the annual deduction limit, $7,000 in your example, gets carried over to the next tax year.
Carryover.
Yes, and you can continue carrying over unused losses to future years indefinitely until the entire loss amount has been used up, either by offsetting future capital gains or by taking that $3,000 annual deduction. And importantly, when you carry losses over, they keep their original character. Short-term losses remain short-term, long-term remain long-term.
Does it matter which ones you use first for the deduction?
Yes, it does. When calculating your deduction limit, you always use up your short-term losses first before using any long-term losses.
Okay, so losses aren't totally lost. They can provide a benefit later. Can you give us a quick example just to make that carryover crystal clear?
Sure. Let's take Bob and Shelley, filing jointly. In 2024, they sell some stocks and end up with a net capital loss of $7,000. Let's say they had no capital gains at all that year. Their regular taxable income was, say, $26,000.
Okay, $7,000 loss.
On their 2024 tax return, they can deduct the maximum allowed, which is $3,000, against their $26,000 income.
Right.
Now, what about the rest of the loss? They started with $7,000, they deducted $3,000, that leaves $4,000.
So the $4,000 carries over.
Exactly. That $4,000 loss carries over to their 2025 tax return. In 2025, they can use that $4,000 carryover loss to offset any capital gains they might have, or if they have no gains again, they could deduct another $3,000 against ordinary income, leaving $1,000 to carry to 2026. It's a system that provides an ongoing way to, cushion the blow of investment losses over time. It turns that setback into a potential future tax saving.
That's a really clear way to put it, leveraging losses over time. Okay, let's shift back to the positive side. Net capital gains. We know long-term gains often get better rates. What are the actual tax rates we're looking at for those long-term gains? And are there different types of long-term gains that get taxed differently?
Right. So when you have what's called a net capital gain, which basically means your net long-term capital gain is more than your net short-term capital loss, if any, that gain amount often gets taxed at special lower maximum capital gain rates. These are generally much lower than the rates you pay on your ordinary income, like wages or interest. For 2023, the main rates were 0%, 15%, and 20%.
0, 15, and 20%. Which rate you pay depends on.
It depends on your overall taxable income level. There are specific income brackets tied to each rate.
Okay. But you hinted there might be other rates, too. Are there exceptions to this 0, 15, 20?
Yes, there are a few specific types of long-term capital gains that fall into higher rate categories, regardless of your main income bracket. It's important to identify these.
Right, tell us about these special higher rate categories. What kind of assets or situations trigger them?
Okay, first there's the 28% rate gain category. This rate applies primarily to gains from selling collectibles that you've held for more than 1 year.
Collectibles, like what exactly?
Think works of art, rugs, antiques, metals like gold or silver bullion, gems, stamps, coins, even certain alcoholic beverages if held as an investment. Generally, things considered luxury or collectible items.
So profit on that vintage baseball card collection held long-term gets hit with 28%.
Potentially, yes. That 28% rate also applies to a portion of the gain from selling qualified small business stock, the part that isn't eligible for the Section 1202 exclusion, which is a whole other topic.
Okay, 28% for collectibles and some small business stock gain. What else?
Then there's the 25% rate gain. This rate applies specifically to the part of your gain from selling real property that you held long term, which is called unrecaptured Section 1250 gain.
Unrecaptured Section 1250 gain.
Hmm.
That sounds complicated. What is it in simple terms?
Basically, it relates to depreciation. If you own depreciable real estate, like a rental property, you likely claim depreciation deductions over the years you owned it.
Right, lowering your taxable rental income each year.
Exactly. When you sell that property at a gain, the IRS essentially wants to recapture some of that depreciation benefit you received. The portion of your total gain that's attributed to the depreciation you took is generally taxed at this 25% rate.
Ah, so it's like paying back some of the tax benefit from depreciation, but at a specific 25% rate on that part of the gain.
That's a good way to think about it. Any remaining long-term gain on that property after accounting for the 25% portion would then fall into the regular 0%, 15%, or 20% categories based on your income.
Got it. So 28% for collectibles, 25% for recaptured depreciation on real estate, and then everything else long-term is 0, 15, or 20.
That's generally right. Any other long-term capital gain that doesn't fit into the 28% or 25% buckets falls into the 0%, 15%, or 20% rates determined solely by your taxable income level. This really raises an important point. Understanding these different rate buckets and where your income falls isn't just about filling out the forms correctly after the fact. It's really about strategic planning. Knowing these rules can influence decisions about which assets to sell and when to sell them to potentially manage your overall tax liability much more effectively. A little foresight here can make a big difference to your bottom line.
That's a great point. It's not just compliance, it's strategy. Wow. This deep dive really has, I feel, pulled back the curtain on capital gains and losses. We went from the basics, what's a capital asset, what's a disposal, to uncovering those really helpful exceptions that might simplify things. We dug into the key forms like 1099-B and 1099-S, learned how to handle adjustments like commissions, and got into the critical difference between short-term and long-term holding periods. And finally, how to manage losses with deductions and carryovers, and understanding all those different tax rates for gains 0, 15, 20, 25, and 28%. Our goal was really to take this potentially overwhelming topic and turn it into knowledge you can actually use. Hopefully you feel a bit more confident and informed navigating your own finances now.
Yeah, and I think this exploration really highlights that intricate connection, that dance between your investment moves and your tax strategy. We've covered a lot of the mechanics, the how-to of reporting, but maybe a final thought to consider is this. How can anticipating these rules before you act change things? Especially thinking about that long-term versus short-term line and those special rate categories we just discussed. How might awareness of those rules influence which assets you choose to hold on to for how long, and maybe even your overall mix of investments? It's not just about reporting past activity, it's about potentially reshaping your entire investment approach looking forward, aiming for better long-term growth and better tax efficiency, something to mull over.
That's a truly powerful thought. Thinking ahead, strategically using these rules. Excellent. Well, thank you for joining us in this deep dive. We really hope this knowledge empowers you to approach your investments and your taxes with greater clarity and maybe even a bit more confidence. Now, go forth, be well informed, and keep exploring.